Welcome to the video. Today we will unpack the hidden tax trap that many people face when moving abroad. Specifically, we will explain why your investment portfolio might be at risk, how brokers verify your residency, and what forced remediation could mean for your holdings and taxes. To keep things flowing, we will move step by step from the problem to practical planning strategies and finish with quick quizzes to help you check your understanding. Here is our roadmap. First, we will explain why your tax residency status matters. Next, we will see how brokers enforce compliance. Then, we will look at country-specific wrappers and common pitfalls. After that, we will compare forced liquidation versus complex transfers. Subsequently, we will cover tax residency fundamentals including PFIC and exit tax risks. Then, we will walk through a pre-move planning timeline and checklist. Finally, we will wrap up with short quizzes and key takeaways. Before we begin, a quick but essential disclaimer. This content is educational and not tax, legal, or investment advice. Since cross-border rules vary widely and change frequently, you should consult a qualified cross-border tax professional in your jurisdictions before making decisions. With that clarified, let us continue into the content. Let us begin with the core dynamic. When you move abroad, your brokerage has a legal obligation under Know Your Customer and anti-money laundering rules to confirm your residency. If you disclose a change or a scheduled compliance review uncovers it, they cannot simply ignore it. If you are confirmed as a non-resident relative to the jurisdiction of the wrapper or account type, the brokerage may restrict your account. If the account contains resident-only or prohibited wrappers, the broker may initiate forced remediation. This typically means either liquidating positions or arranging transfers under complex cross-border rules. Either route can produce significant tax events in your new country, including recognition of gains, exit taxes, or specialty treatments such as PFIC exposure. With that mechanism in mind, we can now explore wrappers and why they are particularly sensitive. Country-specific tax wrappers are typically designed for residents of that jurisdiction. When you leave, you may be barred from making new contributions, required to close or transfer, or subject to broker-imposed restrictions. Even if a wrapper can be legally retained, some brokers will not service non-resident accounts due to licensing, compliance, or operational risk. Moreover, your new country may not recognize the wrapper's tax benefits, meaning that growth inside the account could be taxed currently or on exit. Because policies vary by provider and jurisdiction, you should review legal eligibility, broker service policies, and the receiving country's tax treatment. Always document what you learn and seek written confirmation before you relocate. Now that we have the wrapper concept in place, let us compare the two common remediation outcomes. There are two broad remediation outcomes. On the left is forced liquidation, where positions are sold immediately. This realizes gains or losses and can crystallize at market lows or highs, producing unexpected tax liability in the new country. While operationally simple, it can be financially costly. On the right is complex transfers. Here, you move assets to an eligible custodian, often subject to international rules and broker-to-broker coordination. Transfers can introduce classification risks, for example, foreign funds that are considered PFICs under certain tax regimes, and may interact with exit tax regimes or require extensive reporting. Transfers can reduce immediate market risk but add administrative complexity, delays, and future tax exposure. With those trade-offs in mind, let us step back and establish how tax residency is determined. Tax residency is determined under domestic rules that can include day count tests, center of vital interests, and habitual abode criteria. Where two countries claim you as resident, a tax treaty may provide tiebreakers. Your residency status determines which wrappers you are eligible for and how your accounts are taxed. Your former country may impose exit taxes on certain unrealized gains when you leave, especially for larger portfolios. Your new country may treat some of your existing holdings unfavorably, for example, classifying non-local funds as PFICs for local taxpayers, which can lead to punitive tax and reporting. Treaties can mitigate double taxation, but you need proper documentation and sometimes proactive elections. Now, to avoid being caught off guard, let us lay out a timeline for pre-move planning. This timeline illustrates a staged approach. 12 to 9 months out, you inventory all accounts and wrappers, and check your brokers, policies for servicing non-residents, while you schedule an initial session with a cross-border tax advisor. 9 to 6 months before the move, You simulate residency outcomes under domestic and treaty rules, model taxes for liquidation versus transfer, and identify PFIC, or extraterritorial exposure. 6 to 3 months prior, you request written confirmations from brokers, prepare compliant transfer routes, and pre-schedule disposals if a step-up or recognition event is advantageous. 3 to 1 month before departure, you update your KYC documents, pause contributions to resident-only wrappers, and archive statements and complete cost basis records. In the move month, you notify institutions in sequence after executing the key portfolio actions to minimize risk. During the first 90 days after arrival, you anchor residency documentation, open compliant local accounts, and begin any new reporting. By the first tax season, you file dual country returns as required, claim treaty relief where applicable, and complete exit and foreign asset reporting. Here is a practical checklist. First, map every account, including wrappers, funds, and pensions. Second, check each provider's policy on servicing non-residents and seek written confirmation. Third, identify resident-only wrappers and determine how your new country will tax them. Fourth, model the taxes for liquidation versus transfer, explicitly including PFIC and exit tax cases. Fifth, plan the exact sequence of actions for selling, transferring, or holding, and in which order to minimize risk. Sixth, stop contributions to sensitive wrappers and capture complete cost basis data. Seventh, update your KYC documents and addresses at the correct time to avoid premature restrictions. Eighth, open or prepare receiving accounts before departure. Ninth, assemble documentation for treaties and residency evidence. 10th, engage a cross-border tax specialist early and schedule follow-up checkpoints. With this plan, let us briefly ground the concepts with a quick table of common wrapper pitfalls. This table presents themes rather than definitive rules. Many wrappers are intended for residents and can face service restrictions after you move, even when the law allows retention. New contributions are often prohibited. Your new country may tax internal growth, irrespective of wrapper benefits in the original jurisdiction. Specifics vary widely, so the key is to verify provider policy, domestic law, and treaty interactions for your situation. With these examples in mind, let us test your understanding with a quick quiz. Quiz time. Which event most commonly triggers forced remediation by your broker? Option A. Market volatility exceeds 10%. Option B. The broker confirms you are a non-resident for a resident-only account. Option C. You make a profit over a certain threshold. Option D. You rebalance your portfolio. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. When the broker confirms you are a non-resident for a resident-only account, they are required to act. That verification frequently triggers account restrictions or forced remediation. Market volatility, profits, or routine rebalancing are not the usual triggers. Second quiz. When is the best time to plan for cross-border tax and brokerage impacts? Option A. After you arrive and update your address. Option B. The week you move. Option C. 6 to 12 months before your move. Option D. Only if your broker emails you first. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. 6 to 12 months before your move is ideal. Early planning allows time to model the tax consequences, obtain written confirmations from providers, prepare transfers, and execute steps before compliance reviews lock you into unfavorable outcomes. Here is a compact Markdown-style checklist you can save. First, collect documents including statements, cost basis history, plan documents, and residency or treaty forms. Second, ask providers whether they will service your account after you become a non-resident, what happens to each wrapper upon moving, and whether any penalties or fees apply if liquidation is forced. Third, model taxes in both countries for liquidation versus transfer, identify PFIC or exit tax exposure, and confirm the reporting forms and deadlines. With these notes prepared, let us consolidate the key points before we close. To summarize the essential points, your tax residency status drives both eligibility for wrappers and how your investments are taxed. Brokers are obligated to enforce compliance, and remediation is not optional. Country-specific wrappers rarely travel well, so you should expect restrictions or retaxation. Always model both liquidation and transfer outcomes and document your decision-making. Finally, consult cross-border specialists and begin planning 6 to 12 months before relocating. In closing, moving abroad can transform a stable portfolio into a compliance challenge if you do not plan ahead. Forced remediation may result in liquidation or complex transfers, both of which can trigger tax in your new country. Therefore, proactive planning and professional guidance are essential. Now, let us finish with a quick thank you and a call to action. Thank you for watching. If this was helpful, please like, share, and subscribe. Tell us your cross-border experiences and questions in the comments, because your story might help someone else avoid a costly mistake.